would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Welcome back to it, folks. You've made it to the end of the week. Congratulations. Don't forget that today we will be doing the drawing for the $50 Amazon gift card, which we're doing every month and have been for a while now. I'm not 100% sure where we're at. This one might be the $600 mark, but I'm not 100% sure, so don't quote me. But in any event, if you would like to get your name in the hat for the drawing, make sure to have your submission in before 5 p.m. Pacific time today. And how do you submit your name, you ask? I'm so glad that you posed that question. Head on over to therebelbroker.com. Click the big red button at the top of the page titled Take the Survey to Support the Show. You'll be asked your email address 2 times. Use the same email address both times. Answer a handful of demographic questions, and you're done. The email address is super important. Make sure you do enter the email that you do get. That if I email you, you'll get the message, because that's how I tell you you've won. And then once I establish that there actually is a human being at the other end of that email address, that's also how I send you your winnings. So you'll get a fabulous gift certificate code via email. So that's how it works. So that's why an email address is so necessary. So yeah, jump in. Who knows? You might win yourself $50. And in the process of doing that, you're helping the show grow, and I will be forever in your debt. Interesting continuing exchange with my friends in Connecticut regarding the whole concrete crumbling bad news stuff that we talked about yesterday. The story doesn't even get better. We had kind of an exchange, and I started asking about, well, insurance might cover this, and apparently no, that is not what's happening. They apparently, what's been going on is that insurance companies have sort of been writing this up in a way that only if your house like just falls all of a sudden, if it's something that happens over a long period of time, it isn't covered, which is the most bizarre thing I've ever heard of in my life. Let's see. They changed, according to the good folks I talked about yesterday over at Maz Real Estate in Tolland, Connecticut. They changed their policies, quote, they changed their policies when they got wind of an issue to state the house was to have sudden collapse in order to pay. Thus, all of these homeowners are left holding the bag. Many have sued only to lose. Those few who have settled have been instituted a gag on the discussion after the fact. So we don't even really get any more information on what the process was, what worked, what didn't work, because as part of the settlement, they're required to not discuss anything relating to the settlement. And that's actually not a horribly uncommon thing. It's unfortunate. Really, the only solution is mitigation. And according, again, to these my friends here in Connecticut, it's anywhere from $150,000 to $250,000, which is nuts. I ran some numbers by some other folks, looked on a couple of websites. I saw one website talking about a price of anywhere from $30,000 to $100,000, depending. I talked to a local guy just before the show who kind of gave me the same numbers. He went with $50,000 to $150,000 for an average-sized home or bigger. You know, that was the range, assuming there's no other huge complications. So it's absolutely not a cheap process. It would be something that would be a relatively small portion of the cost of a home here, but I got to think that in other parts of Connecticut where maybe a home doesn't cost $1 million, that cost in many cases could come up real close to what a home might sell for. I don't know for sure. I don't know the market. Maybe the folks over at Maz Real Estate will give me a further update on that. But I wanted to let you know what the story is. I think that stuff is nuts, and I think it really just reinforces the idea that y'all should go out and check your foundations. Look for any cracks. Check for anything going on. I think the earlier you find something like this, the better off you're going to be. And I really feel sorry for folks who are negatively affected by this, even the folks who don't have anything wrong with their foundation. If I was a buyer and these were the headlines I was seeing in the Connecticut area, I sure would be worried. And you know what? What would be the responsibility of a real estate agent in that market? If you just keep quiet about it and someone ends up buying a house and 2 months later this problem crops up, first, if you're a real estate agent and you know this problem exists and you do not tell anybody, I got to think that you're going to have trouble sleeping at night and potentially could end up in an orange jumpsuit, or at the very least, paying a really big fine down the road or paying a judgment down the road. We have a similar thing I hate to even compare the two because one is just so much more immediate and such a huge problem. But one thing I tell everybody who wants to move to Morgan Hill is that the groundwater has had measurements of perchlorates in it, which you only tend to find in rocket fuel and road flares, and it's not good stuff, and it's really hard to get out of the drinking water. It's apparently managed, and the city's taking care of it, but I absolutely make sure everyone knows about it when they purchase in this area. So it's an important thing, I think, to make sure everyone's aware of all the stuff floating around in the market in terms of challenges and what the markets are facing. But boy, I sure don't envy the folks in Connecticut for this problem. That's just huge. And I bet this quarry isn't even in business anymore. I know that in the case of us in Morgan Hill, the factory that used to make the road flares, right? We discovered that we discovered this perchlorate problem, and sure enough, there was a road flare manufacturing facility here in Morgan Hill years ago that's since gone, and it's history, right? But the perchlorates remain. So, all right. So I wanted to give you the lowdown on that. We're going to go ahead and move forward with some other news today in the wide world of real estate. Of course, we always have to dip in with the less than enthusiastic articles that scare us just a little bit. There's an article from realtor.org, which is what it sounds like. It's really sort of the public information arm of the National Association of Realtors. As home prices continue to rise, some mortgage lenders are loosening their underwriting standards so borrowers can purchase properties sooner. That sentence should scare the crap out of you, and that's just the first sentence of this article. It's a contradiction, right? If home prices are continuing to rise, the idea of loosening underwriting is idiotic. Because all that does is make prices go higher. You bloat prices. When you increase the number of folks who get money by loosening underwriting standards. Remember, whenever someone says words like that, those magic words, loosening their underwriting, that means subprime lending. By definition, that's what it means. It goes on to say, and quotes someone named William E. Brown, president of the National Association of Realtors, the reality has sunk in that there are buyers out there who will be able to buy homes and make the mortgage payments. Okay. Great. But do they qualify? Do they have a good credit history? By definition, the folks you're suggesting we reach out to in this case don't, because you're suggesting a change that increases the number of folks who get money, which by definition means we're reaching down to people who are not as qualified. The industry is, quote, trying to give them more options to buy a house. Mortgage giants Freddie Mac and Freddie Mae are rolling out new programs to spur home ownership. And some lenders, God, doesn't that just scare the hell out of you? It does me. And remember, when they say Freddie Mac and Fannie Mae are rolling out new programs, that doesn't mean that they're giving anybody money. It means that they are creating programs that banks, like every bank you deal with, will underwrite and then will purchase them after they've been underwritten by the banks. Right? So in other words, these banks generate the loan and then get it all through underwriting and get it all approved and simply check the check boxes that are required by Fannie and Freddie so that once it's been underwritten, they can then hand that loan off to the federal government through one of these government-sponsored entities, through Fannie or Freddie, which means that original bank is done. If that loan is defaulted on, that bank is not at risk. Just Fannie and Freddie are at risk. And that should scare the crap out of you because you are Fannie and Freddie. The taxpayer is Fannie and Freddie. I swear. You know what's funny is every once in a while I'll have a moment, right? I have a few listeners who contact me on a fairly regular basis. I have one gentleman who's just convinced I'm nuts, that the real estate is not going to see a downturn. And I'm perfectly happy to entertain those conversations. If someone can point me to something that clicks or rings with truth, I'm all for it. I would love to dream of lollipops and sugar plums and all that kind of wonderful stuff, giving the world a Coke and a smile and all the other wonderful things. But the numbers just don't tell me that right now. So when I get into those conversations, and what's great is I'm convinced I have the most awesome audience in podcasting because I don't get, well, okay, with only a couple of exceptions, I don't get crazy people. I don't get just people throwing stuff out that aren't thinking about it. I love that I get thinkers, who are reaching out to me, and I just don't see it. I don't see the real estate insulated process where other things can go wrong and real estate continues to charge on. And all of this stuff that we're talking about feeds the beast of bad real estate. Fannie and Freddie should scare the crap out of everyone. If Fannie and Freddie had not existed as entities before, the downturn of the last time probably would not have happened. They were instrumental in securitizing loans. They are the process through which banks get out from under risk. And for my money, banks should own risk. If banks were under the impression they were actually going to have to hold on to the paper that they were going to underwrite, they would be very responsible and keep very close track of that paperwork. We wouldn't find ourselves in situations where after 6 years, no one knows who actually owns the loan. That just wouldn't happen. But because we get the government involved and everything gets delegated to them, and of course we all know how wonderfully organized the government is in terms of keeping track of things, that stuff just gets lost. It's absolutely ridiculous, and it amazes me that we're on this ride again. It's not like this is new. It's not like we need to guess about what happens when these things happen. We have life experience. Most of us were alive when the bad things happened last time, so there's really no excuse. All right, so moving on with this article. And remember, just like I always say, whenever you're reading an article or anything like that, understand where their bread is buttered. This is the National Association of Realtors. The National Association of Realtors has a vested interest in a robust real estate market where people are buying, because that means there will be more real estate agents, which means there will be more people paying dues. And if there's more people who are paying dues, that means that they're members of the association. And if they're members of the association, they're probably going to need to advertise. And if they're going to need to advertise, that means that the MLS and Realtor.com has access to a larger pool of people to buy their advertising products, so that their listings can be given preferential treatment and different colored backgrounds and all these other wonderful things. It's a money play, right? It just makes sense from their standpoint. Some analysts, well, wait a minute, what was it? Mortgage giants Fannie and Freddie are rolling out new programs to spur home ownership, and some lenders are moving to relax standards to avoid losing business as home prices and mortgage rates rise, says Guy Sakala, publisher of Inside Mortgage Finance. Quote, if your business is going to drop 20%, you need to come up with ways to offset that. So remember what business is for banks. Business for banks is loaning money. If banks aren't loaning money, they are not making money. When everyone talks about that prime lending rate, right, that rate from the Fed, that's the rate at which banks are getting the money. And so that's why you get charged some amount above that. And then the bank makes the difference. Some analysts caution that this shouldn't create fear about lenders returning to the lax standards that were commonplace prior to the last housing crash. At that time, some mortgage borrowers didn't have to put any money down to buy a home. Still, others in the industry warn lenders to be vigilant against creating another unsustainable housing boom by relaxing underwriting rules. This is what happened last time, says Edward Pinto, a fellow conservative think tank American Enterprise Institute. He's right. What they're doing is exactly what they say they don't want to do. Underwriting standards still remain stricter than in the past, though borrowers have more loan options. But see, here's the deal. This is a key. When they say underwriting standards still remain stricter than in the past, that is kind of true and kind of a lie. For instance, they haven't changed the credit score that you have to get in order to get certain loans. The number has stayed the same. So let's pretend that in order to get a really great loan, you need to have a credit score of 740. All right? Well, over the last year and a half, while they haven't changed the credit score you need to have to get these loans, they have changed how that credit score is calculated. So now that medical judgment against you disappeared. It's not being part of your credit anymore. That's been since July. So it's done, no longer counted. Other civil judgments against you, not counted. The fact that you pay your phone bill and your water bill and your electric bill on time previously didn't have any kind of an effect on your credit score. Now they positively affect your credit score. Credit scores are being fooled with so that the person who would normally get a 680 is getting a 740 on their credit score. And we talked about that on previous shows. You can go to therebelbroker.com and check that out, but plenty of past shows have covered this phenomenon. So they're not technically lying there. No, the standards are exactly the same. We did not change one number that means this person gets to have a loan. We just kind of screwed with how that number gets calculated for people. Though borrowers have more loan options, such as 3% down mortgages, they typically must meet credit requirements to qualify. Also, Fannie and Freddie 3% down loans are capped at $424,000. It goes on to state that after the housing crisis, Fannie established a debt-to-income cap of 45%, making an exception for borrowers who put at least 20% down and could show they had enough savings to pay their mortgage for 12 months if they lost a job. But last month, Fannie did away with those special requirements and raised its cap to 50%. Fannie says borrowers with a debt-to-income ratio between 45% and 50% still have to prove their credit worthiness in order to get a loan. Now remember, think back, how do they prove their credit worthiness? With those numbers that have been screwed with. The Urban Institute called Fannie's new policy a win for expanding access to credit and estimated it would lead to the approval of 95,000 new loans annually. There's been other things. We could talk about how Fannie has also launched a program to allow borrowers to use income from household members not on the loan, which shouldn't be allowed. You're either on the loan and you're on the hook for it, or you're not. This, I'm sure, will come to bite someone in the butt at some point. No question in my mind. Freddie officials said the move was to help increase opportunities for Latinos who often live in multi-generational households. Well, then great, put them on the paperwork. The reason why they don't put them on the paperwork is there's a very good chance that the other person who would be contributing doesn't qualify at all, regardless of Latino or white or any other color. Just the numbers, right? Wouldn't work. All right, folks, we're going to take a quick break right here, but don't go away. We'll be right back with, I don't know, good news, bad news? Hard to tell sometimes. Thanks for listening. We'll be back in just a sec. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner-broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Hello, everyone, and welcome back. We've kind of done a quick recap of some shenanigans relating to things like Fannie and Freddie, lending practices, underwriting, credit scores, and all that stuff bears repeating. It's continuing. The only good news we've seen is that Fannie and Freddie are kind of putting an end to the 1% loans and the 0% loans that were happening because banks were putting up the difference in those numbers, right? So it would still be a 3% loan as far as Fannie was concerned, but the lending institution would put up the 1%, 2%, 3%. And of course, you're still paying that. They're just wrapping that into the total amount that's being financed. So what's the right move, right? We've talked about this before. Everybody wants to fool with it on this side of the equation because this is the side of the equation that feeds the bank monster. In other words, creates more business for them. My ideal world would be one where you don't get these artificial moves, these regulatory moves that are specifically designed to not help borrowers. I don't want anyone to equate allowing someone to borrow more money than they're able to handle a good thing. It is turning people into livestock that simply produce a benefit for something else. And in this case, a benefit for the banks. Banks should be held responsible for their own lending practices. If they do stupid things, if there's no business out there, if no one is borrowing, well, then they need to come up with more creative ways to make things happen. We don't need regulations that artificially push this process along so that banks can continue to rank up money. I want to see some banks go bankrupt. It's a natural part of the business process. Over the course of my life, I've worked with an awful lot of folks. The last gentleman I worked with in helping him buy a home had 3 companies go bankrupt on him. He's done a dozen companies. 3 of them have gone bankrupt. It's part of the natural cycle. The fact that we don't hear about more banks going under should actually worry us, because if you think every single bank is run effectively, you haven't met enough people. So there's that. I dislike that because that's what this smells like. You know, when you discover that all of these folks in Congress and lots of folks in the state houses of the various states have family members or very close friends, and of course they do, right? These are folks who have to go out and beg people for money to get reelected. Now, who has all the money? Well, the banks do, right? So, and of course they have tons of lobbies that have tons of money to spend. So when it comes time to do things, these folks are always leaning towards creating regulations that push this idea of empowering banks to lend more money, not because it's helping the little guy. If anything, it screws the little guy and puts them under a burden that oftentimes they cannot handle. It really just helps the banks because the banks are the ones who benefit from being able to lend that money. So let's talk about the flip side of this equation. What is really the problem? The problem is not lending. It isn't. I'm sorry. I don't care what anyone says. The problem isn't lending. Some of you really disagree with me on that point. I just haven't seen enough evidence to convince me otherwise. Lending's not the problem. It's building. Now, I've mentioned this before. What's the solution? The solution is to get the hell out of the way of building. Now, of course, the markets are different all over the country. I understand that there are some of you out there listening who live in a marketplace where it may be the complete other way around, where homes may not be selling. And I get that may be true in some areas, not true in the major metro areas, not true in my area by a long shot, not true in Los Angeles, San Diego, Boston, New York, Miami, just not true. At least not yet. Who knows? It may happen, but it isn't happening yet. There are still so many people who want homes that in the area where people demand homes the most. So let's phrase it that way. In the marketplaces where there's the highest demand for homes, we need to get the hell out of the way of building. And I'm not even going to suggest we go full on libertarian and do a San Antonio where there's no plans or no zoning or any of that kind of stuff. I wouldn't mind trying it, but I'm not going to push it. All I'm going to say is let's roll back all the regulations, all the costs to, say, the year 2000. I don't think anyone's going to argue that we were doing horrible, horrible things, building unsafe buildings in the year 2000. But the truth is, here's the other side of the coin. Just like the lending side, the regulatory issues relating to the lending side are really designed to help banks. They're not designed to help the little guy. I get that people want to say that, and I get maybe it feels like it is when you're putting money into hands of people who can't handle it. But the can't handle it part isn't doing anyone a favor. On the other side of the equation, what politicians saw was this robust marketplace going on, which was unhealthy to begin with, right? Because it was all built on this crazy lending practices of the 2000s, and created all these regulations. They figured, who can we screw that's going to cost us the least amount of votes? right? Who can we really just stick the knife in and have money come gushing out so that we as a government entity can take that money and make it part of our general fund, and we can, fund this special thing in my district or that special thing in your district, so then you'll vote for my thing. All the little political circle jerks that go on need money. So how do they do it? How do they ride this wave of amazingly, dramatically increasing home values? Well, regulation, that's how you do it. You create bizarre fees that have no links to anything other than we want your money. There are communities in California where if you're a developer and you're building more than a couple of houses, you're going to get charged an extra fee of $100,000 per house just because you're building a house. Now, why do they do it that way? Why don't they just make it a $100,000 thing for everybody? Because they want to offend as few people as possible. If you're just Joe Blow and you buy a lot and you want to build your dream home, well, if you start having to pay $100,000 a pop, or everyone who does that has to pay $100,000 a pop, well, that ends up on the news. Well, if you're some evil developer who buys hundreds of acres and develops it and preps it, and then a builder comes in to build, well, you're just the evil guys for whatever reason. So, and there's only one of you. You're a company, so we'll screw you over. And the reality is that person doesn't get screwed. The person who buys the house from him gets screwed, because that price that cost gets transferred to the buyers. So yeah, the regular folks are paying it. They just don't know they're paying it. And of course, that's just one example. There's the number of regulations. If you want to look at a chart that just sort of lays out the number of regulations and the cost of complying with regulation just since the year 2000, it skyrocketed when the real estate market did its boom. As of the last time we covered this topic, which I think I spotted an article we covered from the National Association of Home Buyers last year. So my understanding is this number is higher than it used to be. But back in May of 2016, on this show, we talked about this number of 24.3% of the final price of a new single-family home was relating to government regulation. That's a pretty gigantic number. It seems like we could easily trim that and bring costs down. So what's the solution? The solution is, instead of pushing for all these regulations, all these changes that will push more money into people's hands, get out of the industry's way and let more homes be built in the areas where they're needed most. That solves the problem. Because once you do that, prices stabilize. They tend to stay either flat for a very long time so that incomes can have time to catch up, or if we're in a real normal market, prices actually go down a little bit. And people are able to purchase because the supply isn't artificially depressed by regulations that make it financially stupid to build more reasonably priced homes. When you're seeing that much regulation, you need to recoup the costs. You're going to tend to cater to the higher end because that's going to give you the best return. All right, folks, I did want to do a little bit of a review on that today. I've had a few folks who I've chatted with online and via email. We just need to sit down and think through what really solves these problems. And too often, in fact, just about all the time, the folks in charge come up with the wrong solution. And what's worse is, while I haven't really explored this in the past, I've simply said they're stupidly pursuing the wrong solution. And that sort of implies they don't know what they're doing. And that might be a disservice. I think they do know what they're doing. I just don't think what they're doing is what they claim they're doing. And I've already told you, I've already laid out what I think that is. There's clearly a process in place that emphasizes this idea of the banking industry washing up the politicians and the politicians washing up the banks and keeping everybody well lubricated in terms of cash flow. And unfortunately, I think that plays into this in a way that ends up with us getting hit over the head with a stick. All right, folks, as always, I hope we have left more value on the table than you have invested in time. That's always the goal. And particularly on a Friday, because you're going to have 2 whole days to let this stuff bounce around in your head and germinate and become bigger thoughts. So hopefully that happens. I truly appreciate you all spending your time with me. Thanks again for listening. I'll talk to y'all next time.